Hello, everyone. Welcome back to the Investing Iguana, where we talk about all things money and how to make it work for you. I'm your host, and today we're going to discuss a very interesting topic, the shockingly simple math behind early retirement by J.L. Collins. Who is J.L. Collins, you ask? Well, he's a very successful author and financial blogger who has been writing about money and investing for over a decade. He's also the creator of the popular stock series on his website, where he explains the basics of investing in a simple and easy-to-understand way. He's also the author of the best-selling book The Simple Path to Wealth, which is based on his stock series and covers everything you need to know about achieving financial independence and retiring early. The book is a quick and easy read that delivers a powerful message. The book challenges the conventional wisdom that retirement is something that happens in your 60s or later, and that you need to work hard and save a lot to achieve it. The book shows that retirement is not a function of age, but of income and expenses. The book also demonstrates that saving and investing are not complicated or boring, but rather simple and exciting. The book inspires readers to take control of their finances and pursue their passions. The book is not without its flaws, however. The book assumes that readers have a stable and high income, and that they can easily cut down their spending without sacrificing their happiness. The book also glosses over some of the challenges and risks of early retirement, such as inflation, market volatility, healthcare costs, and social isolation. The book may not be suitable for everyone, especially those who have debt, dependents, or low income. Now, you might be thinking, retiring early? That sounds impossible. How can I possibly save enough money to quit working before I'm 65? Well, that's where the shockingly simple math comes in. J.L. Collins has a formula that shows you exactly how much you need to save and invest to reach your retirement goal, no matter how old you are or how much you earn. And the best part is, it's not complicated at all. In fact, it's so simple that anyone can do it. So, what is this formula? Well, it's based on two key concepts, your savings rate and your withdrawal rate. Your savings rate is the percentage of your income that you save and invest every year. Your withdrawal rate is the percentage of your portfolio that you withdraw every year to cover your living expenses in retirement. The higher your savings rate, the faster you can grow your portfolio. The lower your withdrawal rate, the longer your portfolio can last. J.L. Collins suggests that you aim for a savings rate of at least 50% of your income and a withdrawal rate of 4% of your portfolio. Why 4%? Because that's the safe withdrawal rate that has been proven by historical data to last for at least 30 years in most scenarios. If you follow these two rules, you can retire in about 17 years, regardless of your income level. Sounds too good to be true, right? Well, let me show you some examples to illustrate how this works. Let's say you earn $50,000 a year and you save 50% of it, which is $25,000 a year. You invest this money in a low-cost index fund that tracks the stock market and earns an average return of 7% a year after inflation. How long will it take you to reach retirement? Well, according to J.L. Collins' formula, you need to multiply your annual expenses by 25 to get your retirement number. Why 25? Because that's the inverse of 4%. If you withdraw 4% of your portfolio every year, it will last for 25 years or more. So, if your annual expenses are $25,000, the other half of your income, then your retirement number is $625,000, $25,000 times 25. That's how much you need to have in your portfolio to retire. Now, let's plug these numbers into a compound interest calculator and see how long it takes to reach $625,000. If you start with zero and save $25,000 a year at 7% interest, it will take you about 16.6 years to reach your goal. That means you can retire at age 41 if you start saving at age 25. Not bad, huh? But what if you earn more or less than $50,000 a year? Does that change anything? Well, not really. The beauty of this formula is that it works for any income level as long as you save 50% of it. For example, if you earn $100,000 a year and save $50,000 a year at 7% interest, it will still take you about 16.6 years to reach $1.25 million, $50,000 times 25, which is enough to cover your annual expenses of $50,000 in retirement. On the other hand, if you earn $25,000 a year and save $12,500 a year at 7% interest, it will also take you about 16.6 years to reach $312,500, $12,500 x 25, which is enough to cover your annual expenses of $12,500 in retirement. As you can see, the key factor here is not how much you earn, but how much you save. The more you save, the faster you can retire. And the less you spend, the less you need to retire. It's that simple. Of course, there are some assumptions and limitations to this formula. For instance, it assumes that your income, expenses, and returns are constant and predictable, which is not always the case in real life. It also assumes that you have no debt, no taxes, no fees, and no other sources of income or expenses in retirement, which is also not realistic for most people. And it doesn't account for inflation, market fluctuations, healthcare costs, or other factors that can affect your retirement plan. So, how do you deal with these uncertainties and challenges? Well, that's where J.L. Collins' book The Simple Path to Wealth comes in handy. In his book, he goes into more detail about how to optimize your savings rate, how to invest your money wisely, how to adjust your withdrawal rate based on market conditions, how to minimize your taxes and fees, how to diversify your income streams, how to protect yourself from inflation and healthcare costs, and how to enjoy your life before and after retirement. He also shares his personal story of how he achieved financial independence and retired early himself, as well as the stories of other people who have followed his advice and done the same. He also answers some common questions and objections that people have about his approach, such as A. What if I don't like stocks or don't trust the market? B. What if I have a lot of debt or a low income? C. What if I have kids or other dependents? D. What if I want to buy a house or a car? E. What if I want to travel or pursue my passions? F. What if I get bored or lonely in retirement? J.L. Collins has a clear and convincing answer for each of these questions and more. He shows you that retiring early is not only possible but also desirable and rewarding. He shows you that you don't need to be rich or lucky or smart or special to achieve this goal. You just need to be disciplined and consistent and follow his simple path to wealth. So, if you're interested in learning more about this topic and getting inspired by J.L. Collins' wisdom and experience, I highly recommend that you check out his book, The Simple Path to Wealth. You can find it on Amazon or on his website jlcollinsnh.com. I'll leave the links in the description below. And that's it for today's video. I hope you enjoyed it and learned something new. If you did, please give it a thumbs up and subscribe to my channel for more videos like this one. And don't forget to leave a comment below and let me know what you think about J.L. Collins' formula and his book. Have you read it? Are you following it? How is it working for you? I'd love to hear from you. Thank you so much for watching, and I'll see you next time on the Investing Iguana.